All right, let's talk about building a rock-solid financial case for your next big IT project. You know, the kind of case that actually gets the green light from the people upstairs. Let's jump right in. So this is really the million-dollar question, isn't it? You know your project is a game changer, but how do you prove that? How do you translate all that potential into the language that the people who hold the purse strings actually understand?
See, to get that yes, you have to speak the language of business. And that language, well, it's all about financial metrics. It's not enough to just have a fantastic idea. You have to prove that your idea is going to deliver real, tangible value.
Oh man, we've all been in this spot. You're giving the pitch of your life, you're full of passion, and then your boss just looks at you and asks that one simple, kind of terrifying question, what's the return? So let's figure out the answer to that right now.
Okay, first things first. Let's get into our first and maybe most famous tool in the toolbox, return on investment. You've probably heard it called ROI. This is the classic starting point for pretty much any financial checkup.
At its heart, ROI is just beautifully simple. All it's trying to answer is this. For every single dollar we put into this thing, how much profit are we going to get back? You can really just think of it as the ultimate bang for your buck calculation.
Let's walk through a super quick example. Imagine we're building a new piece of software. So, step 1, you add up all your costs. The development, the testing, marketing, the whole shebang. And let's say it comes out to $80,000. Then, step 2, you look at your first-year revenue, $150,000, and you subtract those costs. That leaves you with a net profit of $70,000. The last step, it's just simple division.
And boom, there it is, an ROI of 87.5%. So what on earth does that actually mean? It means for every single dollar you invested, you got that dollar back plus an extra 87.5 cents in profit. Now that is a powerful number to bring into a meeting.
So is 87.5% good? Well, it depends. I mean, first off, anything positive is good. It means you're making money, not losing it. But really, ROI is often used to compare a bunch of different potential projects. You'd probably pick the one with the highest number. Plus, a lot of companies have their own internal rule, like they won't even look at a project unless its ROI is over, say, 10%.
Okay, so ROI is a fantastic start, but it's got one major blind spot. It treats all money as equal, no matter when you get it. To really build a sophisticated case, we've got to wrap our heads around a crucial concept, the time value of money.
And it all comes down to this one simple but incredibly powerful truth. A dollar in your hand today is worth more than a dollar you're promised next year. Why? Well, for one, you can invest today's dollar and start earning money on it right away. And then there's inflation, which means that future dollar will buy you less. And, there's always the risk you might not even get it at all.
So how do we actually deal with this in our calculations? We use something called a discount rate. It sounds a little technical, but it's basically just a way to shrink that future money down to what it's really worth in today's terms. It accounts for that risk and loss of opportunity.
And this is where things get really interesting. Because once we understand this discount rate idea, we can unlock two much more powerful and sophisticated metrics: net present value, or NPV, and internal rate of return, also known as IRR.
So let's start with NPV. Now what it does is it takes all the future cash your project is going to make over its entire life. It discounts each of those payments back to what they're worth today, adds them all up, and then it subtracts what you paid to start the project. The number you're left with tells you, in today's dollars, exactly how much value your project is creating. A positive NPV is what you're aiming for.
Let's look at another example to see this in action. Say a project costs $100,000 up front, but it's expected to bring in $40,000 in year 1, $50,000 in year 2, and $60,000 in year 3. Using a discount rate, let's just say 10%, we can figure out the present value of all that future money.
And when you run all those numbers, you get this, a positive $22,764. And this is the key. It means that even after accounting for the fact that future money is worth less, this project doesn't just pay for itself. No, it actually creates over 22 grand in additional value for the company. Now that's a compelling story.
Okay, so our next tool, IRR, looks at the whole thing from a totally different angle. It kind of flips the question. It asks, what's the magic discount rate that would make this project's NPV exactly zero? In other words, what's the project's own, built-in annual rate of return? It's the project's break-even point.
So here's the bottom line with IRR. You just compare your project's IRR to the minimum rate of return your company finds acceptable. If your IRR is higher, and hopefully much higher, then it's a really attractive investment.
It shows you how much wiggle room you have before the project stops being profitable.
But let's be real for a second. Numbers are great, but they're not the whole story, especially when we're talking about the wild world of IT. These projects have their own unique quirks and uncertainties that a simple calculation just can't capture on its own.
I mean, just think about it. IT projects are swimming in uncertainty. Costs can change, revenues are hard to predict, technology is evolving at lightning speed, markets shift, and you're often dealing with things like intellectual property, which are super valuable but really hard to put a price tag on. Your financial story has to acknowledge these risks.
And this is where risk analysis becomes your best friend. You can use methods like sensitivity analysis to stress test your numbers. Ask questions like, what happens to our NPV if sales are 10% lower than we thought? Or you can use scenario analysis to paint a few different pictures, a best case, a worst case, and a most likely outcome. This shows you're not just hoping for the best, you're prepared for reality.
So let's pull all of this together. We've just assembled a really powerful financial toolkit that's going to help you make your case with confidence.
I want you to remember these 4 pillars. ROI, that's your quick and dirty profitability check. NPV is your true north, your measure of real value creation over the long haul. IRR is your project's effective interest rate. And finally, risk analysis. That's what gives your numbers context and makes them believable. Put them all together, and you could tell a really complete and convincing financial story. With these tools in your back pocket, you're not just pitching an idea anymore. You're presenting a data-backed investment opportunity. You're ready to answer those tough questions and prove that your vision isn't just innovative, it's truly valuable. You've got the tools now. Go build your case.